I want to start off with discussing the Fed. This week, there was a lot of speculation as to whether the Fed is going to raise interest rates or not, and there was a lot of data that I had said I needed to take a look at, most importantly being the GDP, particularly the revisions, and obviously the current quarter. In addition to, there were some labor statistics numbers, and there was also the amount of the wage growth, so to speak. That's really what the Fed has been looking at. And the truth is that unfortunately the GDP came in about as I had expected, pretty crappy. It was about 2.3%, which was below the 2.4% consensus. They did improve the amount that last quarter had missed. There was last quarter we had discussed that there was a negative 0.2% GDP, meaning that we had had a negative quarter. They revised that to positive 0.6, but they also lowered the GDP mean from the last 3 years from 2.3% to I think it was 2.1%. And in Fed speak, that's a pretty big disaster. That means that growth over the last few years has been lower than they had thought it was. And the big problem I find that the Fed has made the last couple of years, particularly, I mean, you could even take a look at the estimates of the IMF and the central bank, the ECB, with regard to Greece and their growth. The same mistake is happening here. The Fed keeps overestimating the recovery. I think it's sort of wishful thinking. And that's really not what's happening here. The labor participation rate, which is the percentage of Americans working, is the lowest since 1976. It's been jumping up and down 0.1% here and there, changing, but it's been pretty awful. The durable goods orders, again, were really cruddy. They had quote unquote rebounded, but all of the rebound was just in aerospace. So if you weren't making Boeing airplanes, you weren't making anything. It doesn't sound much like the numbers that have come out of Caterpillar were fairly crappy. The stock is sort of bouncing a bit. The copper is kind of in the middle of a crash. Oil is not doing well. You just had ExxonMobil and Chevron give earnings numbers today, and they were rather crappy. I mean, they're suspending buybacks. They are going to keep their dividends, but the prospects for dividend growth seem like they're dimming a bit. Oil is correcting pretty significantly. I've been saying that this roughly about this in the 45s is kind of going to be the line in the sand here. That's the primary trend. We did have a violation of it the last go round, but it wound up holding. I don't necessarily know if it will hold or not. We'll have to see. The outlook for global growth is really slow. I mean, China is kind of imploding. Their markets are not doing well. This is not a recipe for a Federal Reserve that's going to want to start an interest rate hiking cycle. I've been saying lower for longer, and I've been using that little hashtag lower for the number 4 and longer, and I still believe that to be the case. Some of the talking heads today started to discuss that as well. That should be better for the mic. There seems to be a bit more of a consensus now that September might be a little bit too soon for the Federal Reserve to start hiking. I don't really see them pulling the trigger on a interest rate rise without having a news conference, and if they can't do it in September, that kind of takes the rest of 2015 off the table. So that's that. If you take a look at the TLT, it today got up to the channel high. It closed roughly on it. It was kind of testing above it. I've been saying the target here was going to be about 123. We got 122.90, which is quote-unquote close enough for government work. That's really where the big breakdown took place. So this is a very important decision point here in terms of interest rates, whether they are going to go lower or whether they're going to rise here a little bit. So I had been saying that this would be a good area to book some profits if you haven't already, and it would be a good area for right or right out short if you're a bond bear. I don't necessarily know that that's going to be the move. to play the short side of the equation here, but we're gonna know pretty soon, and I think that if interest rates start coming down a lot, the next shot here in the TLT will likely be up to the 126s and potentially to fill a gap up to 127.29. That is going to get the recession talk going. If that does wind up taking place, amazingly, oil has been crashing, copper, the commodities have been crashing, China kind of has been crashing. Things haven't been going well, and the only thing that's really held up is the S&P 500. And the question is that going to last, or is that going to be next? And I don't really know the answer to that. I am very, very mindful and cautious that the answer to that could be yes, and if it is yes, it's going to get ugly fast. There's been about an 8-month or so consolidation up here at highs. It's just been sucking in a lot of people longer and longer. And if this eventually breaks, there'll be a lot of people trapped and there'll be a lot of supply up ahead. There is a trend in what I discuss the market on close orders very often. I post MOC, and for most traders this is probably not going to be as useful with regard to your trading styles as it might be if you're a day trader and you're just sort of looking to know whether you're going to have the wind in your face or at your back going into the close, depending on how you're positioned. But the trend has been to the sell side, and it's been to the sell side fairly regularly and largely, and when it's not to the sell side, it's mostly rather small. This is a little bit ominous because the people who use market on close orders tend to be larger institutions who are selling lots and lots of stock. So the quote-unquote big boys are distributing stock. Now, I'm starting to get the impression that the market might be, it's either setting up for two things. One, it's going to set up for a pretty nasty correction, or it's going to be setting up here for the blow off top where there's just complete capitulation to the upside. One of the things that is going well for the bulls here, I know I've sounded a little bit gloom and doom here, but I want to emphasize that that does not have to be the only scenario. There is a potential for higher. The 61.8% Fibonacci retracement didn't hold this week fully, but the 200-day moving average did, and we have a higher low in place on the SPY. And that came in the form of the 206s, and I had said that if we can clear over 207s, we were going to see 210s, and we did. We even got into the 211s. We closed today roughly at 210.50. So technically there's not that much damage done in the market, although I believe the broad indexes are hiding a lot of weakness in the market, particularly I had mentioned those commodities, and you could even see in stocks like Apple and Exxon, they have not been really doing well. With regard, one more thing to circle back, if you want to see a sustainable low and bottom in oil, I really would need to see Exxon back to hold 83 and to clear 86. If it can do that, then I think that there's a low in oil, but I don't necessarily know that there is here. I have been looking for oil to bottom. I have been sort of nibbling a little bit on these stocks. Some to some avail. Some have been done well. Some have been kind of just choppy here. But I do believe that commodities and markets tend to overshoot a little bit. There was a gentleman on TV who's been bearish on oil for a while. He was talking about it being into the 40s like I had been. He's now discussing stuff going into the 20s. I don't know if that's sort of, to me, pushing his luck a little bit there. But I do believe that oil is going to be searching for a bottom soon. Exxon and Chevron are going to probably start with layoffs. That's going to not help the unemployment rate. They're going to stop with their exploration and production, and they're probably going to start cutting back on oil. The U.S. has been doing that for a while, but the Middle East has not. There's been some talk about the Saudis maybe cutting some oil production. I know there's a lot of fear about Iranian oil coming onto the market now that there seems to be a deal with Iran. So there's a lot of uncertainty around oil, and I think that that's been weighing on the oil market, in addition to China slowing, India slowing. All of the BRIC countries, right, Brazil, Russia, India, and China, which had all been the growth engines of the world, have all flamed out. I mean, Brazil was in a pretty nasty recession, possibly a depression. Russia, we all know, is fairly uninvestable with Vladimir Putin, who's trying to reconstitute the old Soviet Empire, it seems like. India also going through some slowing, and China, we know the story. They had a pretty euphoric market that blew up on them, and the economy there is slowing. So I'm also seeing some signs in some real estate in New York. I think the rents are for the first time starting to peak out a little bit here. So there are just some signs, there's some subtle things that are showing that this could be the case. So let's discuss some levels here with regard to the S&P. We did hold the 50-day moving average. I would say that today felt a little bit more bearish than it actually wound up being candlestick-wise. But this 50-day moving average roughly around here is going to be important. I think it's actually 210.02. So keep an eye on these 210s. If we lose 210s, I say the market's a little bit more skittish. Any hold over 210s and it's more bullish, and there could be a throwback to the upside, back to the old all-time high. If we start losing the 210s, obviously we're going to start targeting some of the lower parts of the range. We'll probably be first looking at the 207s again, and then the 204s, and then maybe the 202s. So those are the levels that I see being key. If we can take out this 212.55, is that what that is? Sorry, no, 213.18. The market would have now had a higher low and a higher high and would start to reverse the pattern. I think that would probably get the blow-off kind of move to the upside going. I don't necessarily know if that's going to happen. There's been a lot of stagnation in some big names, like Apple, for example. I've been saying needed to hold 122. It closed below there today in the 121s. The next stop there would be the 119s, which was those after-hour lows, and the gap fill that people might start playing for with Apple is down in 109s, and you have a 61.8 down by 110. So it's possible that you could see a deeper retracement in Apple. If the market gets kind of fugly and squirrely, there is a primary trend significantly lower into the lower 100s, like 101, I think I see it at here. But I don't know how long it would take to get there, but you could see something. It could coincide if it takes a little while to play out near those 109s or 105s. But it's right on the 200-day. This is really important area between here and the 119s. I think Apple has been sort of the leader, has undoubtedly been one of the leaders in the market, particularly the NASDAQ, and it's going to be very hard for the market to do well if Apple is rolling over, considering Apple is now in the Dow, the S&P, and the NASDAQ. Google had a bit of a blow-off top. It ran $50 and then ran another $100. And it's just been sort of consolidating a little bit below the gap. For Google to kind of turn the page to get bullish again, it needs to clear over that earnings gap low of day, which was 678. That to me is really key. If not, there are potential levels for a pullback, and I guess people are going to start playing for more for the gap fill, for further gap fill. I don't know that you'll get the whole thing just because the move was great and their earnings were really great. So it seems to me like Google just might be working off some of the excess from that move. Exxon, like I said, big into the Dow and the S&P. That's going to be a big problem. Like I said, I've been really very cautious. I haven't really loved the market the entire year. I know that's a little controversial. I know most people play long, but I'm very mindful that once a top is in and on a tape, and it's not always pretty. This is looking to me a lot like the top that was put in 2007, where there was no excess. We fell apart on on the financial crisis that I'm just mindful. I like to see ranges break in either way. Playing inside of a range is fun. I guess you buy the low end of the range, right, and then you sell the high end of the range, and that's what's worked. And I've been playing that game, but it makes it a little bit hard to play anything in size. And I've been playing in size that is so small that I almost could contemplate sleeping late every day. I'm just like, this is like almost not even worth doing. You know, I'd rather catch up on Ballers or something on on HBO Demand than play some of the market sometimes, just because it's just this. There's like so often not a lot to do. It's just like this slow grind chop. So we really need to see a break of range, either for the upside to play for the blow off, or to the downside to play for a further, deeper, larger correction. Anyway, let's get into some of the names that you guys had wanted to talk about. Let's start off with stocks. Someone had mentioned that. That's important. That's also a little bit macro here. The stocks broke an uptrend that was really key. It's been rather weak. It stopped just shy of the 61.8, which is around 623, 63. That also coincides with the trend line, and that's going to be really an important level. There is a reference low down here also, roughly around 641. We're above there. Anything below there to me starts getting a little iffy again. It really shouldn't be retracing that low. I've been saying that Intel looks like a head and shoulders breakdown, like a large head and shoulders ready to like go. This is almost like a textbook of head and shoulders. I know a lot of people don't like to play Intel because they're playing, you know, more sexy names, but these stocks are huge and really matter. It had a gap fill. It's sort of hugging this like 29, 27 area. That's like the is that what I say? That's the neckline. 29, 65-ish. Let's say 29s. If it loses the 29s and is roughly a little bit below there now, the risk is lower, and 26s would be the first stop, and then, believe it or not, it could even be down to 24s, and then there's a lot of ways down if it really starts rolling over. So I would be really careful with the semis. I know a lot of people like the Micron and all these names. Just be careful. The index is looking a little vulnerable, as is the leader. We discussed oil. I discussed the data being junky. Priceline, someone mentioned. So Priceline broke out of the channel about a week or so ago. It fell back in this week, and now it's back up above. The pattern looks pretty bullish, actually. It's got to make a higher high though here. You need to take out this 1280.97. And then you'd have a confirmed higher high off of a higher low, and then you could probably retest the old all-time highs. The pattern actually, as crazy as it sounds, this looks a little Google-ish. I don't know that it's going to have the same type of move. It may have got a little bit of the move already. Something that happens a lot with Priceline is that it gets the move on Expedia. That's why Priceline was up a lot today from Expedia. I believe Expedia is better than Priceline at this point with regard to their with regard to their execution. The stock has had a lot of relative strength to Priceline. Their mobile app is better. And they do something a little bit funny with how they advertise their prices. They don't include the tax, so they always wind up coming out a little bit slightly cheaper than Priceline. And they get a lot of bookings. I used them a lot last year when I went to Europe, actually. And it's a really good service. I like Expedia. It's a little hard to chase it here, I would say, if you haven't been in it. Particularly on this tape, I would wait for some consolidation. You'd like to see a few days and then to take today's high of day for still higher, or to wait for some type of pullback. There has been some very large pullbacks in this stock in the past. It wouldn't shock me to see this run a little bit higher, then have a bit of a pullback, maybe to fill in some of this gap, and then you probably can buy over the kind of the range high, maybe if it came down to like 111s or something. Anyway, back to Priceline. Priceline is expecting a $80 move. Holy cow. Next week is an $80 move into the expiration. That's a lot of points. I would obviously suggest playing this with defined risk options, meaning call spreads or put spreads if you want to play for the downside. Let's see how this goes before it reports. It reports on the 5th, August 5th, so there's a few days between now and then. The ideal scenario actually would for this to be to chop or maybe even to be down a little bit, and I would have really liked this to have not run a lot before the print. But I'll likely be playing this with some type of call spreads or ratios that expire like the week of. And I'll be playing it for like a larger move. Like it'll probably be, what day does that fall on? One sec, I'm sorry, I'm just checking my computer. The 5th, I can't believe we're already in August, it's terrifying me. That's Wednesday. So let's see how this trades a little bit Monday and Tuesday. I don't want to, I don't like getting into these things until I sort of see the whites of their eyes. You know, once in a while they do stupid things like pre-report, like Twitter did or Google did once a while back, and your play could get muffed. So I like to wait until it's like sort of the maximum IV. I like to wait till there's the maximum, you know, till I know where the price is. Like if this runs huge into earnings, you know, you're probably going to want to either play, you know, maybe for a pullback or play for some type of, I mean, obviously some correction. If this winds up correcting ahead of time, you could get some better strikes if you're looking for some call spreads. Since it'll be 2 days to expiration, I'll probably do something where I'm playing for like over $100 move, maybe with like a one. I've been talking to this guy on the stream who I go back and forth with this. And he and I have been doing these 1x3 call spreads that have worked really well. We discussed it on Netflix, at Google, and probably it'll work really well for this Priceline also, where I buy one call and then sell 3 to finance it out of the money. You have to be very careful because if you don't do it far out enough, you can be run over in a way that you don't even want to know about with the deltas. Those are the best when there's like 1 day to expiration. Like if a company reports on Friday, you could do that day expiring weeklies. So if you get into trouble, I mean, you get the maximum theta decay. You know, you don't have to worry about it really overshoot. You know, having continuation the next day or whatever. It's kind of like you're sort of done that day. I'd be looking for something that took this back up to the old all-time highs. That would be like 1378s or so. So I would be looking to buy like those calls and then sell like still higher ones to finance it, or like maybe the last peak was 1339 or something. I'm sorry, 1329. To be looking to do something like that. I don't like to really outlay a lot of premium, but if you're a bit of a gunslinger, you know, you want to you probably want to look to buy something closer to the money and then sell further out. If you're bearish, the clearly the move would be back down to the reference low, which was 1100. 1100s, you'd probably be seeing that fairly quickly if they miss. It might even get fugglier than that, believe it or not. So let's see, but the move is going to be about $80. I would be looking for something with regard to the options that were larger than $80. I want to see where the IV is at the time. Maybe I'll do some type of premium writing, like out of the money writing, maybe some out of the money put spreads and call spreads or so and so forth, just to catch some of the that jacked up premium. The IV percentile right now is 73%, so it's getting kind of big. I would expect it to go even higher. The closer to 100% that gets, the better it is to sell out of the money premium. Anyway, I spent a lot of time on Priceline, but that's what I'm thinking. Tesla. I'm a little amazed that Tesla hasn't been weaker considering the smackdown in gas and oil. The key for Tesla is to hold over the 265. I love that that it's just been consolidating. It's had a couple of breaks to wash out there. I do believe that Tesla is going to see higher. I've been looking for the retest of the 291s, and I've also talked about some Fibonacci extensions and the 320s and 350, like the 350s. I'll talk about that a little bit more in the weekend video, but I do believe that that Tesla probably wants to go higher. I think it's saying something that it hasn't gone down here. just don't want it to kind of run ahead of the print. If it runs ahead of the print, we know it's going to be a little bit harder to play. That also reports on the 5th, so there'll be a lot going on. I don't know if I'll be able. I don't know if I'll be able to do both of these. I'll have to kind of pick which one I want, or maybe do them both in a way that if they go against me, that they can be easily managed. That's always the key, not to get inundated with too much. Everyone always wants to play everything all the time, and just that's not how life really works. All right, so Facebook. So everyone knows I've been a bull on Facebook. I've been calling for the stock to get to 100. It got 99.24. I had said in a tweet that I thought that the sell zone was between 99 and 103 to book some profits. I hope people did, because the stock has pulled back a little bit. Facebook has been doing this pattern for a while where it runs up into earnings. Someone doesn't like something, the foreign currency, or they're spending too much money. It's always the same junk. Their earnings were good. They were fantastic. The quarter was great. The stock is pulling back, so I guess everyone now thinks it wasn't, but it was. The typical pullback in this stock is like $8 or so. I would be looking to, if you can get a big enough pullback, somewhere between 85s and 88s, I'd be looking to sell some out of the money premium. I don't even know if you're going to get that much, but it would be a good idea to see how this stock plays out. Maybe it can come in a bit. I would be looking to sell puts and kind of buy the dip rather than chase the strength. Today it actually got back up over the high. It sort of filled in part of the gap, that the small gap down that it had, but it is holding up fairly well considering the tape hasn't been exactly friendly to social media stocks. If you look at what happened to Twitter, that thing, it was destroyed. I had said I thought that this was a binary trade either to 45 or to 29, and it looks like it's going to be going to 29. I think that the trick here is going to be to buy it for right or right out at 29 half-ish. And if it loses there, it's just a GTFO. Really not much more to say about that. The stock is, the management there is proving to be rather, I don't want to say incompetent, but they're not doing a good job with that property. The problem, I think, is that even a lot of my friends, they don't really know how to use or what to use Twitter for. Everyone knows how to use Facebook and Instagram, so I think it's just a matter of them making the product better. Their earnings were actually really good. Don't let anyone tell you their numbers weren't good. Their metrics were pretty good. The big problem with Twitter was they're not growing, and they have a growth multiple. They are not adding subscribers. Initially, they had reported that they kind of were, and then the number was not proved to be not so much. I think that there was this could have been, believe it or not, a lot worse. I had heard people talking about them even having subscriber contraction. They grew by about 2 million, but that's really not that much. The valuation of the company, if it were to come public today, is probably conservative, but they've proven themselves not to be doing well. So a lot of people are talking about, oh, will Google buy them, and will this one buy them, and will that one buy them? They're not going to get bought, in my opinion, if their growth rate is crappy. Companies buy for growth. I think that I actually believe that Twitter would make more sense with Apple than it would with Google, believe it or not. Although it would make a lot of sense with Google, they're tying in a lot of their search results or whatever. But I think Apple has a lot of artists they deal with, particularly with the music, and I think that they could do something really special with Twitter. Unfortunately, I think that if Twitter does wind up getting a buyout, you'll see, we'll walk in on Monday, they'll have a bid, I'm going to look like an idiot. I think that the bid is going to come in like the single digits or teens. It's not going to be a premium takeout in this instance. So I think it's sort of up to them to fix. If they sort of fix it, then I guess you could play for the takeout because the fundamentals are playing out better. I mean, I heard the same stuff with Yelp the whole way, and I've been telling people on the stream that you can't really play something for a takeout because the fundamentals aren't doing well. I actually believe in the Yelp story, believe it or not. I think they have a pretty good product. I know I don't really use it that much myself, but I know a lot of sort of younger people who do, and I actually do use it once in a while. I sometimes do searches and it comes up with Yelp. But there is a lot of room to the channel low in Yelp, which, believe it or not, is like $11 or $12 right now. So I would be a little bit careful with that. It is possible it fills the gap. There's a huge short interest in this stock. It had been sold off fairly viciously ahead of their print. You know, if you are long, you know, anything below 23.66, you got to be real careful. I'm not really looking to play these stocks right here. If Yelp did wind up coming down that low, you know, like I was talking to the channel low, then yeah, I'd be interested. Either that or it needs to start reversing patterns. I need to start seeing higher highs off higher lows. So that's Yelp. One of the bastions of strength and a story I believe in is these cybersecurity stocks, the FireEyes, the Palo Alto networks. The numbers from FireEye were great. Again, don't let people tell you that they weren't. The problem was the CFO resigned, and there was a lot of concern about that. So the stock, I actually was surprised wasn't down more. It is, though, making lower highs and lower lows. So let's either let it come into some real, I mean, it is into some true support here. I would let it come even lower, maybe like to the 200-day moving average if possible. That's roughly around 39 now. I don't know that it's going to get that low, though. These stocks, you know, you'll wake up on Monday, there'll be some major hacking, and the stock will be up big. But I think the, you know, this was chased a lot. There were like a lot of these weekly call buying chasers in there, and I think they just kind of got their clock clean. My only problem with this here, and I mentioned this the other day, is it's fallen out of the channel here. Excuse me. It regained the channels shortly before they reported, and now it's back below. It's back below all those lows. So I would really need to see it clear over 47.75 to kind of get the momentum, the wind at its back again. But I am looking for a long entry into this. I'll probably do something like sell some out of the money puts. I think that the story is good, but I'm a little bit concerned again about the CFO leaving. Palo Alto is coming into some support. 178s here are the 50-day moving average. The 50 has been the buy point. I'll be looking for that for just a right or right out trade. Either I'm right at that point, or like, you know, it'll go a buck lower and I'll be out. You know, right or right out is exactly that. I'm either right or right out. Netflix, I've been looking for a bit of more of a correction. So much for that. The stock looks pretty bullish. I thought that the correction here wasn't really very strong. I was kind of looking for it to maybe come back to the 50-day moving average, which would coincide with a gap fill around the 98s. Stock had other ideas. It stopped at the 103s, which is no significant reference there. Wasn't even like the top end of the range, like I could say like 102 or 100s, and it's proceeded to rally since then. Yeah, the stock's bullish. I am looking to buy the stock on a real correction. It has not happened, and you know, I'm a bit of a stickler about trade locations. I've played this stock to the long side for the most part. I've caught decent spurts in it. Unfortunately, I haven't caught them all. But yeah, Netflix is still a buy the dip stock. It would be great if we can catch it on some type of a more serious correction. The stock does go through periods of time where it gets those. I just think that their model is finally really proving to be everyone's sort of recognizing that that's the right model. They've been getting some competition though now from HBO and Showtime directly. I fully expect those shows to probably start getting pulled. So there might be some content issues with Netflix. There'll be something that'll come up at some point that'll give the stock a little bit of a knock. But I would say that, you know, it is a buy the dip stock. It's still bullish. Google, I discussed. LinkedIn, someone had mentioned they wanted to talk about. So LinkedIn was a pop and a flop. It got sort of up to the full gap fill in after hours. I'm really disappointed actually that it wound up being this pop and flop. I would have loved to have opened up there during regular trading hours to have shorted the piss out of this thing on the gap fill. I usually don't like to kind of mess around that much in after hours unless I'm defending a position or I need to be in something. But yeah, it got up to those like 250. What was the top? Let me see. Intraday, 1 day, 5 minute. It got up to, let's see. Wow, it really got up there, didn't it? It got even higher. It got up to 260, and then the thing just completely fell apart. They had some stuff come out on their conference call. I don't remember exactly what it is, oddly, but there was some information on there that was not liked, and the stock came down. I'm looking maybe to play now a put ratio for a retest of these lows here, which were down around 191. That was the reference low, and there's also a primary trend comes in around 176s, sorry. So I'll be looking to do some type of put ratio, maybe for a little bit of continuation lower into those levels, and that'll be my play. If it gets back above the high of day today, which was 109.90, then I think there'll probably be a play still for the back to the upside for that gap fill as well, which wouldn't shock me, 227, which would be take it up to like 227. Apple. This is, I already discussed Apple, I believe. So, yeah. Anyway, let's talk about the VIX. And we'll end on the VIX. So, VIX here is at the lower end of its range. It's made it kind of had a bit of a false breakout for a few days. Really came down pretty hard here. And it's now kind of kissing around the lows. The reference range low is 1153. I remember in 2007 there was like a 9 print in VIX. Yeah, I don't short volatility down in the lower end of the range. So if you're looking to play anything, the game now is directional, and you want to do it with what do you mean by data? Do you mean the economic data? I had discussed that a little bit earlier. Just please elaborate on that. So yeah, we'll talk. We'll end on the dollar. That's actually a great point. We'll do the dollar after the VIX. So VIX is really toward the lower end of the range. If you're looking to hedge, it's a good idea to buy some puts in the S&P versus longs. I would say if you want to do some put spreads. I only like to do the ratios when you have a VIX at least 17 or higher, so you can get that sort of $3 spread. That's the spread I like in the weeklies, at least for the SPY. That has not come to fruition with regard to that. The dollar. So let's talk about the dollar. So pull up that chart. Damn it. Stocks, tabular software. Oh yeah, we don't have time to cover that, unfortunately. If you tweet me, I'll send you a chart on that. Just remind me. Euro, USD. Let's take a look at the dollar. So /DX. All right, so the dollar is actually is a big problem. A lot of companies have international earnings, and commodities are oil and gold and everything is priced in dollars. And the stronger the dollar gets, the worse that is. The Fed is well aware of this. They've mentioned strong dollar concerns. The problem is that the dollar was looking like it was breaking out. It had a bit of it's just been making higher highs and higher lows. Today it held the 50 and 100 with a pretty decent size hammer. If you get above this last swing high, which was the 98s, I think you're going to zoom back up to the 100 fairly quickly. And the bad news for that is that we could be talking about Fibonacci extensions. And if we are talking about Fibonacci extensions, we're going to be talking about a lot of pain in the stock market. The big 61.8 fib extension is 102.09, so that would be an area. There's 104.12, which is a big level. And then of this recent range, the 1.618 is 105. If we see 105 on the dollar, yeah, there will be QE probably again. We won't be talking about Fed rate hikes. We'll be talking about quantitative easing. You know, if the Fed really wants to start draining the liquidity pool, they might want to first start, if anyone here is friendly with anyone on the Fed, you might want to suggest, rather than starting to sell the bonds, you might want to just start letting them run off. That's also a very viable option. Just don't continue buying. That is my, that's my thesis of how they should do it. I believe that the market is very fragile here. I think that the world is very fragile, and I believe that they need to stay lower for longer. And until I start seeing the data confirm that, I believe that's going to be the policy. The Fed is very good at enacting and managing policy, but their forecasting tools have been really piss poor, and they are wrong on growth, and they are going to have to admit it very soon. Anyhow, I'm going to go into a lot more of this with the charts in more detail. I'm going to cover some other stocks like Taser and some of the other ones that I've been talking about during the week, and Alibaba and all that. Be sure to follow me on Twitter. My handle is @JustinPulitzer. If you caught part of this and you want to see the whole thing, it'll be rebroadcast on my YouTube channel. That channel is Justin Pulitzer Trades. That is listed in my Twitter profile. There's a link. Be sure to subscribe there. You'll get a notification every time I post a video. I usually post about my weekend review videos and also the rebroadcasts of these videos, as well as special edition videos. Really good stuff on there, if I do say so myself. Anyhow, with that, let's have a good weekend, and thank you guys so much for your time and for tuning in. And I will see you guys on Sunday with my weekend review video. Cheers.